Hello everyone, I am Deborah Luila and I would like to welcome you to today's session with Auditax International. Joining me today is Mr. Leonard Constantine, who is the Advisory Manager from Auditax International, and he will be touching base on the IFRS 9 adaptation, its applicability, and most importantly, its relevance to the financial institutions in Tanzania. Mr. Leonard, you're welcome.
Thank you very much, Deborah. Starting with Auditax International, it is one among accounting firm which endeavor to become a world-leading professional service provider, using the team of talented experts to provide the services on audits and risk management, business advisory, tax services, as well as trainings.
We did make mention of IFRS 9 as one of the tools that you will be giving us intel about, and I would like to know what is the purpose of having such a standard?
Okay, speaking of IFRS 9, is one among the international financial reporting standard. Yeah, previous we had International Accounting Standard, IS, but currently they have rebranded those standard to IFRS. So IFRS stands for International Financial Reporting Standard. And IFRS 9 deal with how we should account for financial instrument. So financial instrument has been also defined on the standard as any contract that give rise to financial assets, financial liability, or equity instrument. So the key thing for those listeners will be to know how we define financial assets, financial liability, and the equity instrument, because that's a major component of financial instrument and this is all what IFRS 9 covers. So financial assets have been defined by the standard as a cash or other contracts that give rise or give one entity the right to receive cash payment or payment in the cash equivalent. But also it covers investment in equity of other entities. What is the financial asset? So it covers issues like if you have your cash in hand, it is a financial instrument. If you have your cash at a bank, it is a financial instrument. If you give out loan, it means you're going to have a contract which gives you the right to receive periodic payment. So if you are a landlord and you lease out your property, you're going to have lease contracts, which will be entitled you to receive rental payment periodically from your tenant. So that is what we term as a financial asset. A financial liability is opposite of financial assets. Now these are the contracts which give you obligation to make payment to other party. So for example, if you take loan from the bank, the loan contracts will give you obligation to make installment payment to the bank. So that become a financial liability. Or if you're a tenant, then the lease contract, it gives you the liability to make payment to the landlord. So that will become a financial liability. But it also covers the issue of overdrafts and the trade debtors when you provide the service or goods on a credit where you're not being paid on cash, then contract or agreement that give liability for other part to give us payment as a consideration of the service or good provided. They fall within financial instrument as a financial liability. And the last, we have equity instrument, where now we make investment to other entity by buying shares. So we'll be making investment on equity instrument. So that is all what is covered on IFRS 9 financial instrument. So the standard gives guidance on how accountants should account for their financial instrument. So it covers the issue of the scope of the standard, recognition and measurement, the issue of disclosure requirement, and the presentation. So how those instruments can be presented in the face of financial statement. They've been all covered that standard. What is important that is standard, or what made International Account Standard Board to relight the standard for financial instrument is the fact that the previous standard was seemed to be not adequate enough to provide a proper guidance on how we account for financial instrument. So previously we had one accounting standard known as IS number 39, International Accounting Standard number 39. which was more or less covering financial instrument, but was focusing on the measurement and recognition. So after having review and receiving some comment from practitioners, that the standard was seemed to be not adequate enough to give a proper guidance on how to account for financial instrument, then that give rise to IFRS 9.
Okay, we do understand that the IAS 39 was there prior to the standards that we speak about right now. And I would like to know what are the major changes really that made the shift from what was being used prior to what is being used right now?
Okay, IFRS 9 came to replace IAS 39 because of the two factors. The first and the biggest reason for change, it was a pressure from G20 to respond with the economic crisis happened back then in 2008, where it hit severe on financial institutions. For example, in the Western economy, especially in America, we had a case study for two banks. We have Lehman Brothers Bank and the Royal Bank of Scotland, where Lehman Brothers Bank collapsed because it was focused on providing housing lending. So it was giving loan on housing sector. So after economic crisis, the value of houses went down significantly. So for those borrowers, they found it is better if they let the bank take over the house than paying the loan, because it was very expensive to pay the loan than letting the bank take the house. But also have another case study for Royal Bank of Scotland, where it faced the same, but the investors added up additional capital to rescue the bank from collapse. So that was the case. And it is also relevant in Tanzania. You can even see now with our economic shake due to COVID-19, we had Bank of Tanzania has released a paper around March this year on economic stability and show that the value of houses have went down a little bit compared to period before COVID-19 outbreak. So maybe what happened in the past, if you couldn't have this standard, maybe it could have happened even in Tanzania. Yeah, so it is a case, and it was more resulted from the economic crisis of 2008. People might think that maybe this now is heated financial institutions. Then what about other entities? Because IFRS 9 are used by all commercial entities. As long as you register your company, then companies actually mandate you to use general accepted accounting standard, which are the IFRS in Tanzania. So what about other entities? Are facing the same because the previous standard has some weaknesses on how to account for financial instrument. So now this come to the second reason why we have IFRS 9. So the second reason is about the weakness of the previous standard, which was challenged by being complicated. For instance, it was not providing a transparent way on how we should make provision. For example, if you have to give out a loan to a client, and the standard require you to make estimates of amount that you might not be able to recover. So in the previous standard, we was calling it provision for bad and doubtful debts. So he was making a provision for amount that you think you might not recover. So the way we was making provision with IAS 39 was challenged by being complicated because we had no transparent way on how we do provision that anybody else could come and perform the same and arrive at the same position. For example, the rate used to make provisions, they had no justification. And also the standard was challenged by being too late because it was making provision when the other part is underperforming, or is when you have a doubt of recovering your outstanding balance from other counterpart. Okay, that's why it was termed as the provision for bad and doubtful. So with IFRS 9, we make provision on the expected credit loss. So you don't have to wait until the other part demonstrate that they are not going to pay, or demonstrate that there will be a challenge to recover the balance from them. For now, at the moment when you create a financial instrument, when you give out loan, or when maybe when you are a landlord and you enter into a lease agreement with the tenant, immediately after signing the lease agreement, you should make provision for expected credit loss. If the other part failed to perform its obligation, how much are you going to lose based with the current environment? So with IFRS 9 now we do too sooner provisioning. So it comes to respond with the challenge of being too late in IFRS 9. But the other thing is about the scope. Also, IAS 39, it had a narrow scope. It could not, we are not providing or make provision for all financial instruments. We were more focusing on debtors and loans and receivables. But with IFRS 9 now we make provision on a wider scope. We do make provision even for the bank, for the balance we had with other bank. Because it's not true that when you have your money at bank, you can access it at any time. There are some reasons might happen which might prevent you from accessing your money. So you should make provision for that. We even have the case study for that in Tanzania, like the issue of Bankiem, which is now being taken over by Tanzania Bank. ABOT was put the bank under supervision, so even the depositors did not have access to their money. So you can see there is a lot of things happening in the field that requires also to make provision for other instruments which we were not providing for in the past, like cash at bank, but also our investment in bond. For example, if you buy a government bond, you are given a bond certificate. Yeah? Bond certificate entitle you to receive periodic interest from the central bank, as well as receiving your principal on maturity. So bond certificate also is a financial instrument. So we were not making provision for our investment in bonds, either government bond or corporate bond, showing that bond, there are very rare case for a bond to default. But you have seen for other countries like Zimbabwe, once upon a time the government failed to honor its obligations. So it might happen also. So you shouldn't believe that investment in a bond also, that the default risk is not there. So because the default risk is there, so we should make provision for that. Yeah. So now it have increased the scope to cover even the undrawn commitment. If you have given other parts a commitment that you can do disbursement to them, like for overdraft facility, the bank promise the other part or the borrower that they can withdraw beyond what they have, at any time when they are in financial need. So even for undrawn commitment also, because there is a risk that when they become drawn, the bank will be exposed to risk of default. So even for undrawn commitment, the standard requires also a provision to be made. So it has increased the scope in terms of how we do provision. So that is another or a second reason why we should have a IFRS 9 in place to respond with the challenge of IAS number 39. But also there is another challenge on how we do classify this financial instrument. It was argued that the guideline on IAS number 39 was more rule-based and not principle. Because IFRS are there to give guidance, but not to give direction, to give guidance on how we should account for financial instruments. So the way it was doing classification and measurement in the previous standard was more of a rule-based. It was telling you if you have this instrument, you have to classify and measure using this guideline, without considering how you manage such instrument, or considering how you receive the cash flow from that instrument. So even that criteria for making classification with IAS 39 was challenged also. So with IFRS 9, we have one principal way of doing classification. And this now try to feature the risk management practice of the entity. For example, with IFRS 9, to classify financial instrument, we consider two factors. as a business model and the cash flow characteristic. On the business model, we consider the motive. Why is the entity investing in a given financial instrument? For example, if it is a bank and a financial institution, why do bank give out loan? Okay, that is a business model. And the cash flow characteristic is about how do you receive periodic repayment from other parts. So those two factors are going to guide you on where you should classify your financial instrument. So we don't have the classes for a given financial instrument, but rather our own arrangement decide where we should classify. So you can see the Ebola, it is more of principle based. It tries to address your environment. So with IFRS 9, we have now only 3 classes. They say financial instrument, especially financial assets, they can be classified and measured either at amortized cost, I will explain it, or at fair value through other comprehensive income, or at fair value through profit and loss. So you have only 3 classes. Unlike in the I-39, we had about 4 classes. We had a class for loan and it was a class of loan and receivables. So whenever you give out loan or you have receivable, you have to put it there. Regardless of your motive for give out loan, regardless of the manner where you receive your cash flow from counterpart, you have to put it there. Well, we have the class for available for sale. If you have made investment in instrument which is traded in the active market, you was forced to classify it on available for sale. And if you make investment to an instrument where you don't expect to sell it, but you have to hold it to maturity, the standard required us to put it on a held to maturity classification. Okay, so you can see we had those classification which were based on the financial instrument, but not on the manner we made the instrument. So with IFRS 9, we abolished those classes. For example, the class of available for sale was effectively from 2018 January abolished, and the class held to maturity, it is abolished. So if you go to the financial institution, on the financial statement, effectively from January 2018, for those adopted IFRS 9, you won't find those classes of held to maturity or available for sale. You will now find the classes of amortized cost, fair value through other comprehensive income, and fair value through profit and loss.
Mr. Leonard, some people might be wondering, we have spoken here about the existence of the IAS 39 tool prior to the adaptation of the IFRS 9, which is what we're trying to push for at the current moment. And some people might be wondering, what was the processes, what was the procedures towards this change? Who was involved?
Okay. Yeah, as I said earlier, these are international accounting standards established by ISB, International Accounting Standard Board, the same board which previously used to issue international accounting standards. They said earlier, now they do rebranding. So whenever they make significant change on existing international accounting standard, they rebrand it to IFRS. So ISB, after getting a pressure from G20 and having done their own research and see the weaknesses of previous standard, they opted to do this IFRS 9. So the process of developing a new standard which will respond to all weaknesses of I-39 began way back in 2008. But they are considered to have a convergent with other countries where they don't use IFRS, but they use general accepted accounting principles, GAPs. So this project was so special where ISB joined in with FASB, Financial Accounting Standard Board, which develop general accepted accounting principles in the US. So they did joint project to ensure they improve convergence. And those who are using GAPs and those using IFRS, they should have a better and one way to account for financial instrument. So because IAS 39 had a lot of challenges and seemed to be not adequate to provide accounting for this, it was a big challenge to come out with a new standard which will respond to all the questions and all the challenges observed so far. So they break the process of developing this standard into 3 phases. So first, number one was dealing with the classification and the measurement of financial instruments, which cover financial assets and liability. So they did that until 2011, when they completed and they provided a guidance on how we should classify and measure the financial assets. That's why I said that now classification and the measurement of financial assets will be depending on the business model and the cash flow characteristic. So for them, they said, before you classify your instrument, your financial assets, into either category, either amortized costs, fair value through the comprehensive income, or fair value through profit and loss, you should consider a business motive, a business model. So for example, for a bank, they will ask themselves, on a business model, why are we giving out loan? Okay? We give out loan because we want to receive periodic payment from the borrowers toward the maturity of the loan. Okay? So they start to say, if the motive is to receive periodic payment, which represents the payment of principal and interest toward the maturity of the instrument, and the cash flow characteristic of that instrument is that you receive the payment periodically. The standard require, if you have any instrument of that kind, with that feature, should be classified at amortized costs. And if you have more motive, maybe if your motive to receive periodic payment of principal and interest, but also to sell the instrument whenever there is favorable conditions in the market, then they say if you have the motive to sell also, then you should consider classifying that instrument not at amortized cost, but at fair value through the comprehensive income. So where a business model cannot be established reasonably, or when it is very complicated to tell the motive why we are investing in this financial instrument, for it to be classified either at amortized cost or fair value through the comprehensive income, the standard requires to classify it under fair value through profit and loss class. So there are other literature which say that the classes are two, just the amortized cost and the fair value. It is correct because in this three category, we have amortized cost, fair value profit and loss, and the fair value through other comprehensive income. So the two speak about the fair value, but where you should take the change, you can either take it to profit and loss statement, or you can take it to the statement of other comprehensive income. So as a scholar, they say the classes are two, just fair value and the amortized cost. But when we go to the standard, they mention these three classes. Yeah, that is about how we measure and classify financial assets largely. Financial liabilities, it remained the same with what we had in IAS 39, because we didn't have more challenge on that. But the issue of owner credit risk have now been addressed well in IFRS 9. So that was all about the classification and measurement, which was the first one and it was concluded around 2011. So from there, they went through now phase 2, where they was dealing with how now we should make provision after having observed the challenge with previous standard 39 that is too late to make provision. It's have to wait until indicators for a customer to default or indicators for fail to recover the outstanding balance available is when you start to make provision, which was challenged by being too late. Now they have to come with a regime which will make provision based on the forward-looking information. So now accountants will have to foresee in the future what factor, if they go wrong, the counterpart may not be able to pay. If it is a bank, now the borrowers will not be able to pay. So they have to foresee what other variable in the future might make the customer default. Now with IFRS 9, they developed expected credit loss model. Okay? In the IFRS 39, we had incurred loss model. We had to wait until loss event occur for us to make provision. With IFRS 9 is immediately when we give out loan, immediately when we make investment in financial instruments, we should start to estimate the expected credit loss. It might look ridiculous for a bank if they give out loan immediately to establish how much they're going to lose if a customer defaults. Someone else might ask, then why should bank give out loan? If after giving loan, I should establish how much I'm going to lose, Yeah, but because to the bank, that is a core activity, and so they have to part with the risk of default. But to be fair enough, accountant should have a model or a tool which will give them enough reasonable information regarding the future expected losses. Now it is where IFRS 9 come in place now. So the objective to migrate from the incurred loss model to expected credit loss model is to ensure accountants have a guidance which will give reasonable and reliable information regarding the future expected losses. So with IFRS 9, it requires now accountant to consider a wide range of variables to estimate and establish which factor might make the counterparty default. But also the process of estimating this expected credit loss model should also be unbiased and the probability weighted. So it should cover a wide range of variables to ensure it is unbiased. Don't go and pick variables which will favor you, but also it's supposed to be probability weighted because the future is uncertain. So we should have different scenarios. For example, you can have a best case scenario. If things goes well, what factor will make them default? If things goes worse from today, what factor will make them default? Or things if they remain stable, the business as usual, then what could make the counterparty default? So it's supposed to be a probability weighted. You should consider various scenarios, best case, worst case, and the best case, a business as usual case. So here you find out that accountants now have to think outside the box, the factors which you call a forward-looking information, which might make the counterparty default. For example, because we don't operate on isolation, there is the macroeconomic variables which dictate how the economy is going to operate in the future. For example, the issue of GDP, the issue of inflation rate, exchange rate, have something to do with how the business behaves and the performance of the business on the economy. So also on the forward-looking information, we also consider the issue of movement and expectations, forecasts of the macroeconomic variables. For example, what do we foresee will be the movement of inflation? What do you foresee will be the movement of exchange rate? What do you foresee will be the movement of our GDP growth rate? What do we foresee will be the movement in sector performance, for instance? So this information normally comes from our central bank and the National Bureau of Statistics. So you have to go there and see the forecast of the variables and see how the business will operate in the future. But also we can consider other information like operational results if you are dealing with the other business person. So you can even go through their financial statement and see how they perform. And you can even be able to predict the future by see the historical trend of their business. You can see this business is growing, then the risk of default is very remote or not very far. Or if the business is struggling, she's starting to make losses, or it has been making losses over years. So you have to know once upon a time they'll be suffering the liquidity risk, the liquidity issue. They might not be able to pay us. So you have to ensure you quantify such factor for you to be able to establish the future expected losses. But also other information, for example, for financial institutions, we have Credit Reference Bureau, which give ratings to individuals and entities whenever they want to go and borrow. For example, if the borrower want to go and borrow from a bank today, the bank have the requirement to lodge your file to CRB, Credit Reference Bureau, where they're going to see if you have other loan with other bank and see how you perform with them. Okay, so if you are not performing well with other bank, this bank will be informed through CRB that this customer have defaulted to that bank. So if you disperse to him or her, there is a risk of default to entity. Or this is a good performing customer even to other bank. So they'll get information. But they'll know if you have loan with other bank, your cash flow, if they give you loan again, is it adequate enough for you to be able to pay loan to both entities? So they will consider a factor like that. So there is other factor which we need to ensure they are available. Yeah, so maybe the challenge will be the issue now of availability of data for accountant now to be in a position to establish the likelihood and be able to estimate the future expected credit loss. Maybe that might be a challenge, but for ISB, they come out with a model which will be relevant for accountant to be able now to quantify and foresee the future expected credit loss. So they give guidance like the use of forward-looking information, such as you to consider what information is relevant for a given customer or for a given client where you have outstanding balance with to predict what will be the future losses. And the phase number 3 now, the last phase was about hedging accounting, which I think we should have a separate session for that because we cannot accommodate with the time we have for today. Yeah. So the standard was developed into 3 phases. Phase 1 for classification and measurement. Phase 2, impairment computation using the expected credit loss model. And the phase 3 is all about hedging accounting.